Nice.
So Keith, are you in Arkansas?
I am.
Whereabouts?
I'm in just outside Little Rock, in a suburb. So
North, south, east, or west of downtown?
I am southwest of downtown. I'd be on the way to Hot Springs if you've spent any time around here.
I know Rob has an airport.
So I'm
Oh, Keith,
45
don't get me
minutes.
started.
45 minutes door to door to the horse track. So
I had the opportunity, the pleasure of speaking at an event at a casino in Hot Springs, Warm Springs, Hot Springs last year, with First Trust.
oh yeah.
And got stuck in an ice storm and spent the next 2 days in Little Rock, watching it rain and sleet and be ice cold, and actually filmed an episode of this show from the Bill and Hillary Clinton Airport, which was my first encounter with a drug sniffing dog.
That's right.
So
Well,
Yes.
that sounds like you have the full experience. I mean, that's
that's
every
the full
winter
Little
for us.
Rock experience.
Yeah,
Nope.
we actually had the state NBA board meeting down at the casino yesterday. So
Why not? Why not?
And Rob
So-
should preface too, that was his first run in with the drug dog. So,
Yeah.
you know,
There have been other dogs. There'll be dogs in the background. So Tom, you were asking where I am today. I tried to get a better shot of what's behind me, which I'm about to show you, but I'm once again in Larkspur, California, north of San Francisco, about 15 minutes. And if we could follow me over here, I'm gonna be mobile, and
like
you can
this.
see what happened here. This was
Is that an old playset?
it's a brand new little park, and you can see in the storms, the storms in California knocked over a tree right through the play structure.
Hopefully nobody was in the path of that at the time.
No, it was in you can see the rest of the tree is over there, but
Can you see the rings on the inside? You know how old the tree is? I'm assuming if it's
No,
anywhere
they
near
haven't.
redwoods.
they haven't cut it up yet, but it's yeah, fortunately nobody was injured. It was happened in the middle of the night during one of the storms a few days ago. So, and I was trying to figure out some kind of analogy between the tree crashing through the play structure and the banking industry, but I couldn't give anything clever. So
what about
with that in mind,
the atmospheric river of inflation that has gripped the nation?
that's right. I remember inflation. I remember when everybody was worried about inflation. Now we're all worried about our bank accounts, but not really. But Keith, you're going to talk about that and calm everybody down. Tom, you want to take it away?
Yeah. Well, welcome everybody into the latest edition of the Rundown here. As always, joined by the esteemed co-host Rob Chrisman on location in Larkspur, California. Shy of analogy, but that's all right because we got plenty to dig into today. And really privileged to have longtime TMC member, good friend of mine, president of Centennial Bank, Keith Little, joining us here. And Keith, welcome to the Rundown, friend.
Hey, thanks for having me.
Hey,
Well,
hey,
Keith,
Tom.
Yeah.
Oh, Tom, did you happen to is your bracket already ruined?
Well, I figured, if our conversation dulled people or you just got a little too depressed over the current events of the mortgage industry, at least you can watch your bracket bust in real time. I've got the Marquette and Vermont 2 versus 15 game going in the background. But yes, my bracket was officially busted by about 2 p.m. Eastern yesterday.
Yeah, I think yours and many others. And I did happen to catch a note there from Ira, always the clever wit, asking if a bank if a bank fails in the forest, doesn't make a sound. So I wish I'd thought of that, Ira. Good job.
Right? See, just gotta
Anyway,
hit up our audience for
So-
good analogies to go. But
I've got all kinds of questions for Keith. And Keith, I'm gonna preface this by telling we mentioned inflation, and well, do you want to tell folks a little bit about the bank and what you do there first?
Yeah, well, first, let me say that none of my thoughts, opinions, or comments reflect those of Centennial Bank. Forward-looking statements are not indicative of past results. What else we got here? I don't even know if my wife would agree with half what I said, so don't take it for what it's worth and what you paid for the cost of admission today. But we're a regional bank based in Arkansas, primary footprints Arkansas, Florida, and Texas. All pretty strong markets. People continue to move to Texas and Florida. We're one of the better capitalized banks in the nation. It's not always been easy to explain to loan officers why our portfolio rates are not as aggressive as the people across the street. And that's because it turns out that, investment portfolios aren't the only problems in the banking system right now. When you've got loans tied up at low rates and you're upside down, that math only works for so long. And I think that's what we've started seeing. So, I mean, I think this is just one of the problems of, Michael Lewis wrote a book a few years ago called Boomerang. I think it was about what happened in the financial crisis. At the end of every chapter, it was like, what this country was left in a room with money on the table and they turned out the lights. What did they do? And I mean, I think that's kind of dig of what we saw the last few years. I think people had made long-term decisions as though the free money was going to last forever. And, it's been so long since we've seen a downturn, people forget that cycles are still cyclical and they still happen. So, there's a lot of potential moral hazard we've seen in the last week and can talk about, but what a time to be alive.
amen to that. I know Rob's got some more questions, but I want, for interactivity's sake, in lieu of St. Patty's Day, our attendees can follow along. I know I'll be taking a sip every time the Fed or FDIC is mentioned during today's conversation. So this will be a little more interactive of a rundown, but Rob, go for it. I know you got more for Keith.
I know how to spell FDIC. Don't put that glass down, Tom. Don't put it down yet.
I've got reinforcements ready to go.
So one of the things, and we'll get to like the big issues in a minute, but I'm kind of simple-minded, Keith, just in case you didn't know that. But one of the questions that I'm continuing to receive is what is it about warehouse banks? What is my line threatened? Is my warehouse line threatened? And why is it threatened? And these are independent mortgage bankers and small to mid-sized mortgage bankers who are writing, in some cases larger. What is it about First Horizon? What is it about Western Alliance, who also happens to own AmeriHome? What's going on with these warehouse banks? And Keith, you can correct me if I'm wrong, but as I understand it, the issue isn't so much deposits or stability, but it's more the substance and counterparty risk that companies are feeling in terms of having small and mid-sized mortgage banks as clients. Nothing wrong, nothing bad about mortgage banks themselves, but given the covenants and restrictions that are in place with so many warehouse lines, the fact that small and mid-sized and large lenders have been losing money quite a bit. In fact, the MBA just released their figures today. It shows the cost per loan is up over $12,450 now, which is amazing. And so many of these companies are not having profitable months, are not having profitable quarters. And so it's not the FDIC, which is stepping in and complaining about, there you go, Tom, come on now, or the OCC, or the OSS, or the FBI, or anyway, we get carried away on the acronyms, but it's the fact that the warehouse banks are looking at these independent mortgage banks saying, you haven't made any money. And, paragraph 3, line number 1 is you need to make money in order for us to have an adequate relationship. And we feel that we are at risk because you have not been making money. And yes, we have these covenants in there and these restrictions and so forth, and we've not exactly turned a blind eye to them, but companies aren't making money. And when a company isn't making money, the warehouse bank is going to tend to look at those with more suspicion and with more scrutiny. Are you seeing that, hearing that? Am I all wrong on that? Should independent mortgage banks be worried about that at all?
Well, I mean, I think it'd be irresponsible for me to say that somebody should be worried or not. I mean, isn't that what happened last Friday? Peter Thiel tells people that, hey, you need to be worried about this, that caused a panic. Yeah, I mean, it's certainly a problem that people aren't making money. I mean, that everybody's having to just survive until things turn around. I mean, I think January and February were better months in terms of applications and demand. I mean, I think we've seen how rate sensitive the customer is, that applications went up in January and went down in February. I mean, what happened in February? Rates steadily marched upwards. We got back down to, a little bit more tolerable levels for everybody in January. And then as they start marching back up, demand starts slowing down. You're seeing, demand pick back up in March so far. I think it's a little too early to figure out what the news cycle right now is going to do to customer sentiment. I don't know how many people on Main Street are following all the news. I think everybody on this calls, we're probably watching CNBC more than the average bear. But I don't know how much everybody is following that. But I mean, warehouse lending, which let me caveat again that I'm no expert on warehousing, but this is a short-term play. So the world should look better for warehousers this week, right? The short-term funds started going down for the first time in forever. So at least that should help a little bit. But I mean, it's kind of indicative of what we're seeing in the banking problems is liquidity is the primary concern. But I mean, if I can't speak for, you mentioned too, what in my opinion, good banks that are run by some good folks. And I've known folks at both of those. But I think they've probably, I don't want to say they've ignored covenants, but also they probably feel a responsibility that if I cut these lines off, I'm killing my customers.
Well, and real quick, I mean, Keith, to your point too, it's probably a good week coming up for warehouse banks in general, just to get the phone to pick up a little bit more right now as IMBs think about, where their lines of liquidity are currently allocated. And, if it's not sufficiently diversified, quickly having that conversation internally about, maybe making some pivots just to do that.
Yeah, I mean, that's similar to what some of the, I'll send everybody's founder to this week and talking about stuff, but some of those guys, the tech companies were talking about, yeah, we've kind of thought differently about keeping all of our cash in one place now. So, I mean, it's been a while since talking about counterparty risk was part of, happy hour discussions. But it's always been there. It's always been real. So, I don't know the basic fundamentals of blocking and tackling have changed. It's just a lot of people kind of forgot about it for a while.
So Keith, I know the FDIC is very involved with what's going on. I'm sure you guys are very much in touch with your regulators and auditors and so forth. Any advice that you would give other bankers that are on the line in terms of, say, dealing with without stealing any company secrets, dealing with the FDIC or other folks who are looking over your shoulder?
Well, from that perspective, I don't have to deal with those guys in that capacity. My interactions with FDIC Fed would be more, audit situations and whatnot. But I think the primary mission a lot of banks this week have taken is to communicate to their customer base, hey, this is what we look like. What we've seen so far were banks that were pretty concentrated in some niche areas, or had higher concentrations in things than the average community bank. The average community bank does not look like Signature or SVB, neither do the big money center banks. And I was reading some stuff from ICBA this morning. I mean, community banks, typically know their customers better. And know what's going on with their customers and probably have deeper relationships. So, I mean, I think that's been a lot of what bankers have done this week, as far as talk to those customers and reassure them, hey, this is what our capital positions look like. This is where we're at. This is, no, we did not have crypto exposure, or, we weren't tied to them. I mean, you look at SVB was kind of, well, niche, because I mean, that was a bank that their primary customer base was tech. And I mean, everybody knows, if you watch the market, that when rates go up, when money gets more expensive, tech is, one of the biggest users of capital like that, and they get hit harder than other sectors do. So, I mean, that was, that's unfortunate, but that was the space they were playing in, and that, that got hit harder. So I think that's a lot of, which, I mean, that's a great theme for the year on customer education. So whether it's first time home buyers or deposit customers or anybody, just going out and telling your story and let everybody know where you're at.
Yeah, I think education is counterparty education is very, very important. This is clearly, been made apparent, whether it's dealing banks, working with the FDIC, telling them, what's going on with them, whether lenders, in touch with warehouse banks to say, yeah, I know we didn't make money in whatever month. Here's the plan we have going forward, and being in contact like that is just, I mean, communication is so important. I know that the FDIC, which was formed back during the Depression, I think 1933, to thanks, Tom. I worked that in there for you. So 1933 was when the FDIC was formed, and basically put in place the deposit insurance, and the FDIC has done a very good job of that so far. But we ran up against the FDIC limit, the insurance limit of $250,000, and so many folks from Silicon Valley Bank had accounts much greater than $250,000, and so the FDIC's insurance cap basically didn't quite work. The FDIC has come around a little bit last weekend to say that they're going to insure all accounts, which is unusual for the FDIC to say. So, where do you think we go going forward with the FDIC and insurance limits and so on? Your opinion only, mind you.
Well, I don't know. I mean, did like you said, did they implicitly change the rules of the road by backstopping everything? I don't know. Obviously, everybody's going to want to jump out and say, "Oh, we need more regulation" when something happens. But I mean, you can come with all the regulation in the world, and it's still not going to stop people from making bad decisions and decisions that they made that at the time probably didn't seem bad. I still believe that the human being is, inherently good at birth and not evil, and that people don't run out and try to lose money. So I don't know, but I mean, what they're saying and what they're doing aren't, I don't know. There's been talk of that, not that I've seen from regulators, just, from the talking heads on TV about, are they going to raise that limit or not? But
who's they?
This is mainly hedge fund guys that I've seen out there.
Oh, I thought you were talking about the FDIC raising their limit. Sorry.
No, and if they've had any of those conversations, it hadn't been within my purview. But that they implicitly did that last week. They didn't put an end date on that, so I don't know if we're left to read between the lines. I think their primary concern Friday and over the weekend was to calm the consumer and not cause runs. And as with anything, what is the long-term effect of those decisions look like? I don't know. I don't see how it's not inflationary, but
Yeah, I think the FDIC, other auditors, regulators, and so on. I shouldn't say other auditors, but because the FDIC is not an auditor per se, but to extraordinary measures that are being called in times like this, it definitely backstops things. I would like to think that it would stop some kind of contagion. That's the press's favorite word now. In the last, during the pandemic, it was unprecedented, and now we are onto contagion. But I wouldn't think that obviously we need more regulations per se. And that could be tough, given that a lot of these regulations have to go through a Republican, Congress. So that you bring in the political spectrum, or bring in the political question. But could you explain to folks why, and it doesn't have to be from the FDIC's perspective, just from your perspective, what is the difference between, say, your bank and a large, say, money center bank, and a Silvergate, for example, or a Silicon Valley Bank?
Well, I mean, I think a community bank, and to come to the first point of that topic, I mean, who are we to say that what the FDIC didn't work or not? I mean, we didn't see any more bank failures this week, so I mean, that obviously calmed some nerves of some folks, and I think that was what they wanted to do. I think community banks in general, and the big money center banks are more diversified, in my opinion, than SVB. These guys were pretty, like we said, niche, whereas your average bank is not necessarily focused on just one line of business, or just supporting one customer type. So I think community banks and money center banks are both a little bit more diversified than what we've seen so far is essentially just been two banks that were operating in a niche space. And I guess we can say three, because what Silvergate threw in the towel, without anybody forcing their hand, but they got caught up with FTX. They seem to be the clearinghouse of choice to get fiat currency into crypto markets and back and forth. So, that was unfortunate that they got hurt there. Like you said, SVB was heavy into tech. Signature also had a lot of crypto exposure. So, can you necessarily blame those customer bases who have already seen one catastrophic issue, in the area they operate, be a little bit nervous? I can't blame them. But I think just in general, the entire banking system is a lot more diversified than the examples we've seen so far.
Yeah,
Great point.
I would
Steve.
think. I would think so too. And I'm pretty sure the FDIC thinks that as well. With regard to mortgages, which is kind of your specialty, and I know earlier you said you didn't deal with the FDIC very often, if at all, because you are more on the residential mortgage side of things. So, like I say, wouldn't deal with the FDIC. Has the last few weeks impacted your business, the mortgage business, at all?
I mean, we've kind of what I said earlier. We've seen increased demand so far in March than we did in February. Haven't seen a big rush this week like you would anticipate in a typical kind of refi cycle when rates move this much. So, I mean, hopefully what we're seeing is indicative of a spring buying season, and we're getting back to the good old fashioned bell curve kind of market, and things pick up and people buy houses in the spring and move and whatnot. I think in January, what we saw was people finally were like, okay, rates are higher. They're not going back to a 3 handle. We still need to move. We still want to be in this school district, whatever. And start seeing some activity again. When they went back up 50 plus 75 basis points in February, they kind of, demand stopped. Rates, I think we started seeing, and we'll see what MBA's application data shows, but I think we started seeing applications increase again in March before rates started going back down. So, I'm thinking we're seeing normal activity. I don't know that the average customer out there is following this. This news isn't hitting every TV you walk past, like the contagion from 2 years ago that you mentioned. So,
Right.
I think we're seeing some normalcy, I hope, which is good. That means we've got a functioning, residential market. But I would probably expect to see a lot more demand this week. But, it's like we're living in the prettiest house on an ugly street. It's like, oh, rates are back in the mid 6s, not in the upper 6s anymore. So I don't think those kind of moves when we're in this range are going to swing as much as they would have otherwise.
Yeah, I would think, the Fed will do whatever it takes. I think that the FDIC will do whatever it takes. And it's been very interesting for me, kind of on the outside looking in, to watch both the Fed and the FDIC work together in trying to thwart, what's going on, because I don't know how often the Fed and the FDIC actually work together in conjunction. Maybe you can shed some light on that, but I think it's important for all these government bodies to work together.
Well, and I know Tom's not going to drink if I mention another one, but I mean, you got to lump Treasury in there too. I mean, because they were obviously part of the actions, and I think they're all kind of working together, which that's good, right? That's what we want to see. It doesn't need to be just one entity leading the charge. We need a group of them. It's a big issue.
Well, as a
Yeah.
courtesy, Keith, to the regulatory bodies out there, a collective quick drink here. But everybody, you're with the rundown. Rob, Tom here. We've got Keith Little, President Centennial Bank, in the house. Obviously, a lot to talk through, but just to kind of close out the SVB, Signature, Silvergate, and even First Republic at this point, want to lump them in to a certain degree. Around that discussion, curious your guys' thoughts here. I mean, obviously, Peter Thiel and his Silicon Valley friends spreading word on Twitter. Pretty unprecedented to see $42 billion withdrawn from a bank over the course of 6 hours. Any thoughts to the point of, obviously regular commerce, insured deposits under 250 grand by our friends at the FDIC. If there should be some mechanism in place, kind of in the smartphone era, of being able to move money instantaneously in large sums, if maybe there should be some sort of transfer period, even if it was a matter of a few hours for large sums of money like that to move hands between banks. In this case, maybe it gives SVB the ability to reach out to large stakeholders and, convince them that the ship is not quite as sunk as they may think, to pull back on some of that, quick withdrawal just due to the hyper, information exchange in this environment. Do you think there's any credence to that?
I'll say that I'm just a guy from Arkansas. Okay. So, but yeah, the world is different than it ever has been before, that information can be exchanged that quickly. I mean, what you're talking about sounds like a market trading stop, cooling off period for everybody to stop. And, you had to do that because you got so much algorithm trading out there for a human with a cool head to walk in and say, hey, is this doing what we intended it to do? Or is it just piling on and self-perpetuating? But I don't know. That's an interesting moral question too, because how would the John Q. Public feel about that if the bank says, sorry, we're not going to let you have any money right now. We want you to stop and cool off and make sure this is really what you want to do. So I mean, that I'm happy I'm not a regulator right now. I'm happy that I'm not Jay Powell, because I wouldn't want to be in that situation. But that's an interesting moral question. So
Yeah. To that point, as I said earlier, the FDIC was formed in 1933 because of the Depression. The Fed was formed, I think, in 1913. And if you go back into the banking crises during the 1700s, 1800s, before the FDIC, before the Fed, before they were set up, I think I should have brushed up on my history, but I think at one point the U.S. government called Jay Gould to help stop a banking crisis. And then, as I said, the Fed was formed in 1913, and then the Federal Reserve in 1933 to help do these things. The question is, I would say that technology has grown by leaps and bounds, and a tweet causing a run on a bank. I mean, when they formed the FDIC and the Fed, they didn't foresee foresee this. So, what changes need to be made, and what does the Fed have to do to keep up? What does the FDIC have to do to keep up? It's just the list goes on and on. It's it's not. It used to, in the old days, it used to take all day for a bank line to form outside the bank withdrawing their deposits. Now, it's a matter of a few keystrokes, and suddenly, to your point, you lose millions and millions and millions of dollars in just a few minutes. So anyway.
Well, Rob, real quick, everybody is really grateful for the history lessons of the Fed and FDIC that you've brought to the table this discussion. A lot of concern around my liver. It will be okay. Not my first rodeo, so appreciate the positive support out there in the chat. We will make it through the hour.
They're lashing out, Mr. Curley. Anyway, go on. Sorry, Tom.
Your good friend Brian Levy also recommended never engage in a drinking game with Rob Crispin where there's buzzwords involved. You're a glutton for punishment there. And last thing on the topic before we close it out, we always spend a good time around it. But we know Congress, divided Congress, no expectation that there's any quick movement or movement in general to do something substantial. You touched on the calls for some regulatory curbs in place. Any thoughts if we see something come out of this as far as maybe the Congress to pull back or look to pull back on some of the curbs to Dodd-Frank that allowed maybe a little less regulatory scrutiny on those regionals in the 50 to 250 billion range in assets, particularly around stress tests as we move forward?
Which one are you looking at? I mean,
that was my Stravinsky 30-second question for Rob and put him on the spot.
No, I'm gonna toss that to Keith. I don't see any less regulation. There's a lot of finger pointing that's going on right now. It's kind of like the 2008 financial crisis or whatever it was called. Brokers pointing at mortgage bankers pointing at rating agencies pointing at investors. There's all, people pointing at borrowers. There's all kinds of blame to go around. I'm sure they'll be sifting through this for a while, but I like to think that calmer heads prevail. I like to think that the FDIC is doing its job. I like to think that the Fed is doing its job. I think that they've demonstrated that by working together. And as I mentioned earlier, I don't know how often the FDIC and the Fed do work together, but it's good that they're out there. I don't know if we're quite in the mood for regulation. I know right away there was finger pointing in terms of politics, like, oh, if the Trump administration hadn't pushed for removing these regulations, we would have been fine. I have not looked into that. You're gonna end up with Elizabeth Warren on one side and other people on the other side of that, and it takes a long time for Congress really to do much of anything. And Congress has proven that they're good at fighting the last war, and I think maybe this is a new war that they have to deal with, and there isn't a lot of time to sit there and contemplate and be wise and look back and look at historical experience. I know that both the FDIC and the Fed are steeped in history, and it would be good to think that they are, contemplating what's going on and given the time to do so, because it will take a while to sift out. But in terms of new regulations, maybe it's just a matter of making sure the old regulations are enforced.
Good point. And Rob, to your point as well, like, nobody expects a divided Congress to move quickly. Obviously, both sides have leaned into their talking points. And to your point, stepping back from some of those Dodd-Frank regulations on the regionals in the $50 to $250 billion asset range was bipartisan when it was sent to President Trump's desk at the time. So it's not like, both sides of the aisle don't have some blood on their hands in the process.
Exactly.
Yeah. Well, I'm sure IMB members out here would love to hear a little bit around, the big announcement from FHFA this week around the LLPA DTI fee adjustments, and deciding to punt that to August 1. Just to unpack that real quickly, from the press release, the FHFA rationale was to ensure a level playing field for all lenders and having sufficient time to deploy the fee. Additionally, lenders not subject to post-purchase price adjustments related to this DTI ratio fee on loans acquired by Fannie and Freddie between August 1 and December 31. This temporary price adjustment exception won't alter any QC review decisions by Fannie and Freddie. Obviously, welcome news to the mortgage lending community as a whole. You've seen in some of the industry publications just today, great that we're kicking this can down the road. Would be that much better if we just killed this adjustment in the first place. But would love, Keith, Rob, your thoughts, reactions just to that announcement this week, and maybe any future adjustments we might see down the line.
Yeah, I'm glad we were able to shift the topic off of the the banking crisis and talk about something other than the Fed and other than the FDIC. I know that the MBA has come out and said, in fact, Pete Mills shot me a note that I have in my commentary tomorrow about how a delay. We've lost Tom. I'll talk to Keith. How a delay is good, but sponsored by Wendy's anyway. And but the MBA is pushing for a whole different algorithm. And why even do this now when we're trying to recover as an industry and trying to get this business up and going again and going into purchase season and so forth. So I think it's the MBA views it as a Band-Aid. Maybe not a total fix, but I think it's nice to see. I think that it's good to see that Sandra Thompson, I think, listened to the industry, or people on her staff did. Just like it's good to see like Janet Yellen at the Fed, listening to the industry. So Keith, what are your thoughts?
Well, I've made it no secret I was not a fan of the LLPAs. The DTI was probably the most problematic for implementation, but there's a lot of other logical fallacies in that grid that I think need to be addressed. And you already kind of mentioned it. I mean, the timing could not have been worse for them. I will say kudos to them for delaying it earlier. I was kind of worried we were going to hear something. I figured it would probably get delayed and not taken away with, but we probably wouldn't know until like early mid-April. I mean, how many loans have already been priced in with this in the last couple of weeks? But so I'm glad they pushed it back early. But I think there's a lot of other things besides the DTI that they need to look at in there. I think there's some things that probably that'll look good on the surface, and they cause some issues that could entice people to actually go into a riskier position for the agencies, the way some of those grids are structured. So DTI was particularly problematic. I mean, and I think it's going to continue to be problematic. I mean, if you look at we've talked about how do we underwrite to the gig economy and all this stuff, and I was not a fan of any of the LLPAs. So let's put it that way. So, I mean, this is better than it was, but if you get kicked in the shin instead of stomped on the foot, is that better? They both hurt. So.
Right.
Well played.
Yeah. Well, and Keith, I have to compliment you on being a better man than I am, because you didn't mention FDIC or Fed.
You noticed, Rob. Keith was
once,
very pointed in his choice of words, but Rob has definitely leaned into today's theme to the point where I've had to go back to the third. And just to answer the rumors in the chat, yes, Conway's Irish Ale, Great Lakes Brewery's finest this time of season. If you're not Great Lakes or Cleveland adjacent, I will gladly send you a 6-pack.
So keeping on with this briefly, I think when those changes were made, I think there was a lot of talk about how those changes impact FHA business, for example, because every time an agency makes a change, it has a ripple effect out there in the industry. Just like anytime a correspondent investor has a price change or some kind of policy change, it has a ripple effect because there's a lot of eyes looking at these changes. And so when FHFA makes a change like that, what is the reason and what implications does it have on FHA business and Housing Finance Authority business, and even the jumbo business to some extent. So it'll be interesting. I've been saying kind of under my breath a little bit, or just as an aside, I mean, I've been thinking that I think that, I'm not going to say I saw this coming by the FHFA, but I like to think that they were going to do that, and they have, and now it gives them time, I think, a little bit to really truly reevaluate the situation and think about their actions. So I'm optimistic that here I am going on record. I'm optimistic that I think they will, change it up entirely. I think
So
Sandra.
everybody hold
Sandra's
Rob
good.
accountable for that.
Yeah,
There you
we're
There you go.
40 Central on March 17th. Rob predicted-
Right. We've
mean,
got
they go-
video
Yeah.
record of it.
That's all I
But great
need.
point, Rob. I mean, I think that is an inherent difference that our industry sees from, say, the Sandra Thompson administration versus the Calabria administration, is an open ear to the real-time feedback from mortgage bankers on the IMB and depository side alike, and trying best efforts to be, pivot towards that feedback and really listen to, the members of the mortgage banking community and act in a way that's going to be sustainable for, growth in our industry for the long haul.
I agree.
Yeah, I mean,
I
kudos
agree.
to them. I'm not gonna complain about them delaying something, and to use Rob's words from earlier, calmer heads and going back and reevaluate. Somebody asked, if the LLPAs lead to better capitalization, something I still like. Well, I mean, maybe it'd be nice if somebody told me that's what we're going to do with it. I think there are probably more transparent ways that they could get towards that capitalization. And again, I think there's some logical fallacies in the grids that could have unintended consequences, and it would look like on the surface could definitely have unintended consequences. So, I'm going to hold out hope that Rob's accurate there, that kind of reevaluate that. I mean, if we need to make changes for capitalization, okay, let's do it. Let's just be honest about it. But let's not do it in a way that's punitive to someone that is not posing a higher risk level.
Right. Yeah, I agree 100%. And I think the FHFA, I think, has proven a little more nimble in terms of decision making than, say, the Fed or the FDIC. And so I think Sandra will come around and listen to the industry. So anyway, I think
Great point here, Rob. Yeah, we're getting on to that point. I knew we would run through this episode.
We're getting
quickly.
on to some point, Tom.
Right. It's gonna be 5 o'clock somewhere soon, right? But real quick too, you guys mentioned earlier in the discussion, just a bit of a raise in purchase application activity. MBA released stats earlier this week for final numbers in February, up 4% from January, but also at the same point, home sales down 5% in the month of February from January. Yeah. Any thoughts between the two of you as far as tea leaves to read upon for what we hope would be a bullish spring buying season ahead of us?
I see more leaves.
Keith, you're in the trenches, Keith. I mean, I don't. We started off the year in pretty good shape, and then things changed, and then, I mean, it's right before. It's funny because once again, me and predictions, right before Jerome Powell went onto the Hill to say that we're not done raising interest rates and you better beware. Anybody who was predicting interest rates from the prior week, they had those predictions ruined. And then sure enough, we get a bank failure or two, and all those predictions are, it's like a battle plan is fine until the first shot is fired. But I think we've, looking at the demographics, which I continue to think about, there's a lot of millennials out there who want to buy a home. They're tired of their landlord raising the rent. They want to come home to a white picket fence, or, have a nice little place, or have a place at the end of a cul-de-sac where their kids can play with other kids in the cul-de-sac. And they just want a house. So, apartment living isn't for everybody. So I think the demographics.
Yeah, it's not by any means, but I laugh because there was a good stat that we didn't get to last week, and it was National Mortgage Professional did an article, a pair of articles. The top 10 cities preferred by millennials right now. You can imagine they were all the trendy cities out there where you see a lot of our industry conferences
Cleveland.
held out. That Cleveland was number 11 on the list, Keith. I can't believe it wasn't higher, but Denver, Austin, different California cities, different Nashville, up and comers there. And then they also had a separate report. It was the top 10 most affordable cities for first time home buyers, which naturally our millennial group would fit into that case in most circumstances. Zero overlap whatsoever. So there is, I think, out there a bit of, I want to be where the action is from a career standpoint and a lifestyle standpoint versus what it, a region that might be more amenable to me trying to get into the market as a homeowner. And there's a bit of a disconnect that I don't have the answer to how you bridge that gap, but interesting trend out there.
Yeah.
So I mean,
Well,
Anyway,
we've run out of time.
right?
we haven't
So
even
before we
placed
wrap
our
up
bets
this
on
week, though,
the Fed move next week. I thought we had.
oh, that's what I was going to ask you both. I've heard a lot of conjecture in national media this week. Some that suppose that the Fed will make no move now as to quell issues from the depository side, but yet still want to make some sort of increase as to not scare the market on how close to a downfall we could be. Rob,
Yeah, I think, once again, predictions, but probably a quarter is a token move. I mean, it's very, very difficult for the Fed to both fight inflation and handle a banking crisis. And for the Fed to be able to do that successfully is going to take a lot of skill. Tom, how many times do I have mentioned Fed? So I think they'll go a quarter. I don't know, but it's only because their inflation is still an issue. Keith, what do you think? What the Fed is going to do?
Yeah, I mean, I'll put my money on a quarter raise. Maybe hopefully we're wrong and it's a pause for 2 months and
ordered by the Fed.
Yeah, see what
seems to be the safe bet out there. Yeah,
but no, I mean, I think the Federal Reserve Chair has proven that he is not Volcker. If you look at the lessons in the past, Volcker probably took his foot off a little too early. Now I think the last week made his job and everybody on the board's job a little bit harder.
On the board of the Fed.
Yeah, the
FOMC.
So, I don't know that it necessarily changed anything. I don't think that a quarter raise next week is going to perpetuate this whole nother round of bank failures or anything else. But inflation's still a problem.
Right. What I think, Tom, Tom, do you happen to have like a Zoom call or a meeting with the board of directors or the owners of TMC coming up this afternoon?
For you, Rob, I would make them wait a few minutes. So.
All right. No, I was actually talking about, what's the name of that beer you've been drinking?
Conway's Irish Ale, Great Lakes Brewery, one of their finest. It's not Christmas ale, but it's the next best thing.
Looks like
so. I got a news story.
Great Lakes Brewery this week may be the play, right?
I'm telling you, anybody wants to make a stop up to my stomping grounds, I would be a grateful host. But I do want to drop, just a rumor out there, and we'll see what flight it takes. But many of you know about, our president, COO, Rich Rubinski, making his impending exit from the Mortgage Collaborative. I am happy to announce he has, in part with this move, stepped aside to help start a grassroots campaign. Political action committee is already in place, and hopefully everybody on this call can help raise support. But we want to elevate Rich to the next CFPB director from an appointment from likely the next administration and the presidency. And he has started a super PAC. It's called Franco Gallucci's 529. So Amy, if you would drop my Venmo in the chat, we'd be happy to have our audience contribute to that. And whether Rich ends up being director of CFPB or not, just know your contribution will put a young child through college, and that's what it's all about these days.
Very good.
Rob, I
Keep-
expect your support as well.
Keep us surprised.
Absolutely. So, I mean, before we wrap here, guys, I always got to ask about weekend plans. Keith, I didn't pay attention, honestly, to what happened in the bracket yesterday. How are your Razorbacks looking?
We got a game tomorrow. We got number one
Amen,
seed
brother.
Kansas. So hopefully my Woo Pig shirt will be here in time. So I tried to show you.
That, to be fair, that was my $1 million question for today is, what our audience really wants to know is, Keith, who's your favorite member of the Wu-Tang Clan?
Well, I mean, so you gotta think about what ODB did to hip hop in general. That people weren't really singing and
True.
rapping at the same time. So I think he did bring something new to the table there. Old Bobby Bones, one of the other great Arkansans, he had his Woo Pig shirt on the other night, and you had like 3 text messages. Did you see that? And I'm like, yeah, I'm on my phone right now trying to order one. That's
Tom, there's a question in the Q&A. Somebody wants to know if Keith has seen the movie with the bear that was referenced in San Diego.
Oh, yeah, Keith. So this was big conjecture at TMC San Diego. And what everybody wants to know is, have you seen Cocaine Bear? And if so, what's your reaction? Do you recommend others go see it?
So I have not. I just assumed when we started talking about bears that there was somebody from Multibank Securities that might be behind that comment, if they're still part of the collaborative. So I'm thinking I know
Great
where
friends
that
to
stems
TM.
I
from.
think, interestingly enough, Tom, I read a critic's account of the movie who noted that the movie is dedicated to Ray Liotta. And it's the second worst thing that's happened to Ray Liotta in the last 6 months. So
I love that. Ray Liotta, big fan of mine. Goodfellas, one of
you're
my
a
favorite
big fan of
all-time
his too.
movies. A huge
right.
fan. And I read that article you sent me, and I thought the other great piece with it too was the director is Elizabeth Banks, famous actress. Many people know her from her direction of the Pitch Perfect movies. And I believe the great commentary that I took away was, it feels like Elizabeth Banks is trying to make a movie that's so obnoxious, it's so bad, it's good. But unfortunately, it's so bad, it's bad.
Right. Yep. All right. Well, thank you guys. Thank you very much, Keith, for joining us today, being put on the spot with regard to the banking issues and talk about the Fed and talk about the FDIC. You're a good sport. So I'd like to have you on again sometime.
Well, hopefully I proved to everybody there's a reason I'm on the mortgage side and not on the banking
go.
side.
Yeah,
All right.
Keith is not just a pretty face. And thank you all for joining. Hope you have a great weekend ahead. Couple of green beers in store. Hope your brackets aren't busted yet. They probably will be.
Well,
It's
check
okay.
out
It
that
happens
pit
to
score
all of
back
us.
there. You
Well, I
missed
don't
it.
want to. No,
All right, guys.
just torch Everybody have a great weekend. We'll see you next week.
All right. Bye.